we are going to go over what an accountable plan is, what the IRS's verbiage about accountable plans are, what are the 3 things you need to have covered for the IRS in order to qualify for an accountable plan. I'm going to tell you the 7 most common reimbursements for accountable plans, and then I'm going to tell you a little story about when I worked at the IRS and a company that got audited by an employment tax agent, and they weren't real happy because of some mistakes they made regarding their accountable plan. What is an accountable plan? Simply put, an accountable plan is a reimbursement plan. It's a policy that's written that allows a company to reimburse its employees for costs that the employees have during the course of them working for the company. If you are a shareholder of an S corporation, this is the only way that you can take a home office deduction. You can't use the regular rules to get your home office deduction. You have to have an accountable plan set up in place in order to deduct your home office, because it really is a reimbursement to an employee. As you should be aware, if you are an S corporation shareholder, you should be an employee, and you need to take something called officer's compensation. As an employee of the S corporation, in order to get a deduction for the home office, you need an accountable plan set up. The way the IRS treats accountable plans is it's written very specifically in the IRS code. That code says, amounts treated as paid under an accountable plan are excluded from the employee's gross income. They are not reported as wages or other compensation on the employee's W-2. They are exempt from withholding and payment of employment tax. In other words, if you have an accountable plan set up correctly, the company, or S corporation in this case, can take the deduction, and when the employees get the reimbursement, they do not have to pick it up as income. So it's a deduction to the corporation, and it's not income to the employee. Now, in order to get the accountable plan to work, there are 3 rules that the IRS wants you to follow in order to qualify for your accountable plan. They are business connection, substantiation, and return of excess. Business connection. You have to be able to prove that the reimbursement in the accountable plan has some form of business connection. With your home office, that's super easy, because as long as you're using your home office for exclusive use, and I've gone over all the rules regarding home office in my last video, but it's pretty simple to show that the home office has a business connection. Substantiation. That means the employee needs to be able to substantiate what it is that they're asking to be reimbursed for. Typical forms of substantiation are things like travel log, invoices, receipts, the business purpose of your trip, how you calculate what your home office use is to your employer. Those things are part of the substantiation. The third rule is return of excess. That means that if the company gives you a bunch of money for your reimbursements, or they give you an advance, and then when you do your substantiation, it turns out that they overpaid you, you have to return that extra money. A simple example is you decide to go to Florida on behalf of your company. You go to your boss and you say, hey, give me $2,000 in advance toward my reimbursement. And then you go to Florida, you do a bunch of work for them. When you come back, you substantiate your expenses. You find out that when you're doing your substantiation, the amount of reimbursements you're actually entitled to are $1,700. You must return that extra $300 the company gave you in order for you to meet the return of excess qualification of an accountable plan. The 7 most common reimbursements under an accountable plan are travel, meals, office supply, business development like continuing education or courses you need, telephone and internet, your home office deduction, and mileage reimbursement. Those are the ones that are most common when you're doing accountable plan employee reimbursement. Now let me give you a little story about when I worked at the IRS. I worked in the employment tax audit division, and I had an associate of mine that audited a big company for employment tax. They were doing worker reclassification, officer compensation audits. Since it's an employment tax audit, they had to look into reimbursement. And when they were looking into the employee reimbursement, they went to them and realized, hey, you guys have a lot of employee reimbursement. And the first question the auditor asked them was, can you please give me a copy of your written policy for your accountable plan? And it turned out they never had a written policy. And because they weren't able to provide a written policy for their accountable plan, all the employee reimbursements were no longer deductible for the company. It caused a huge mess for them. So it's really, really important that when you set up your accountable plan, make sure to go over your policy with your CPA for how you want certain reimbursements to be paid out, whether you're a single owner S corporation or you're a big company that reimburses employees regularly. Make sure that you cover your policy with your accountable plan. So we've gone over what an accountable plan is, how the IRS deems accountable plans, what the 3 things are you need to have in place to have a qualified accountable plan, what the most common reimbursements are, and if you don't have a written policy, how you can get busted. I never know how to end these things, so I hope you learned a lot about accountable plans. If there's anything I left out or you want some more clarification, please just go ahead and put questions in the comments and I'll get back to you. Thanks a lot.